really the movement here, what we should be focusing on is move-in rates.
Yeah, I think that's right. It's the big, sort of, if you will, the macro issue of the year is, have we gotten to the point where good news is bad news in the sense of economic growth, in terms of wage growth? Does it mean that the Federal Reserve has to hike rates faster than they have been in the past or faster than the market has been anticipating? If so, then you get the sort of move higher in yields that you've observed in the recently released CFTC positioning report. Non-commercial traders have never been more short of two-year note futures. So people are clearly betting on higher yields moving forward, and yeah, that has an impact on stocks. Good news is bad news once again. It's been a while. It feels like maybe we're getting towards normalization, Julia?
Dun, dun, dun. Reassessment at least. But for those, put some of the equity moves that we've seen this week, because we've been reiterating, look, on the grand scheme of things, yes, it's been a tough week for investors, particularly in equity markets, but if you put it in perspective of the gains that we've seen year to date, then, you know, some balanced portfolio assessment, which is what you can provide, I know, is needed here, I think.
Yeah, well, I think there's a psychological phenomenon where as soon as you make a bit of money in the market, you sort of assume it's yours and that you want to hang on to every last drop of gains. And if you're not used to being, if you will, punished by the occasional drawdown, and let's face it, over the last sort of 13, 14 months, you haven't been, then you sort of almost feel entitled. Every time the market goes up, you're entitled to that money because you know it's going to go up the next day. And so this is just a little bit of normalization, if you will.
We're talking about that fear of missing out, the FOMO, FOMO trading strategy.
That's what's driving a lot of the moves. Jim Paulsen, let's bring you into this conversation as well. We talked earlier about how the narrative is kind of changing here. People are rethinking what the Federal Reserve is doing, whether they're behind the curve, maybe the Federal Reserve not so much anymore. What are you hearing from your clients? What are you hearing from customers you speak with?
Well, I think they're a lot like others. You know, they've been made more optimistic by the trends over the last years, both in the economy and the markets. But certainly they're concerned with the high valuations that we have. You know, I really think it is a move from good news to bad news. You know, if you think about over much of this recovery, we've had kind of sluggish growth, but low inflation, low interest rates, which has allowed high valuations on relatively slow growing earnings. But now in the last year and a half, we've come to the conclusion that U.S. is doing better. It's probably growing more like 3% in real terms than 5% in nominal terms. And not only that, but the whole world is now in a synchronized growth expansion for the first time ever. And at that type of environment, we can no longer run the recovery with low inflation, low interest rates. If we're going to have higher earnings, which we're getting, we're probably also now with faster growth going to have that with higher inflation and higher interest rates, and that means we're going to have to lower the valuations of stocks and bonds. So I think this is an adjustment, and I don't think it's over. It might not continue with a straight line next week, but I think it's an adjustment of lowering the stock market's PE valuation and raising the yield level on bonds to more appropriately reflect a U.S. economy growing probably 5% plus in nominal terms, with probably wage and CPI inflation moving above 3%. We'll probably get through it, but it's probably going to mean like a 10 to 15% stock market correction and maybe a treasury of 3.25 to 3.5 before it's completely over.
So you mean this is the start of that?
I kind of think it is. Again, I don't think it's necessarily going to be a straight line into next week. It could be. Sometimes it does it in a flash, or maybe it's just the start of a step function downward. But I think we've got a little further to go. Because I do think the world economy in the U.S. has upscaled its nominal growth rate in a fully employed economy, and that's going to mean that we're going to have higher inflation and higher interest rates and lower valuations on financial assets.
So I was just talking about fear of missing out, Cameron. What do you think of that, the likely 10 to 15% correction there that Jim was talking about? And what drives it?
It's certainly, I mean, obviously it's possible because we've had them many times in the past. I would say that if he's right about the 10-year going to 3.25 or 3.5, it makes it eminently more likely. The question is, again, can we do that? Absolutely. Will we? Well, I would think at some point you'd see asset allocators come in and maybe start to to tilt their portfolios a little more towards fixed income. Pension funds haven't had the opportunity to get a 3% 10-year in more than 4 years.
Yeah.
So at some point that will become more attractive. But I mean, clearly in the near term, the risk is that these so-called 60-40 portfolios, where you buy 60% of your portfolio in stocks and 40% in bonds, and listen, you've made money like nobody's business over the last year or so. It's had a little bit of a drawdown. Now maybe you start to see people sort of get out of that strategy a little bit, which push things further.
Jim, what's the trade then? Buy vol.
I'm sorry?
What's the trade then? Buy vol.
Well, you know, I think that I'm not sure the bull's over. I think it's going to correct here, and then maybe the bull continues next year. But in the meantime, I would do some things. I would probably debond my equity portfolio a little bit, not have a lot of interest-sensitive stocks in my portfolio. I'd move away from the United States. I don't think the international markets have to correct as much as ours. I would look to add a little commodities. Maybe a commodity ETF is a substitute for a part of my equity portfolio. And really, for the first time in this recovery, cash has a return. And it's going to probably be pretty close to 2% by mid-year, and that's getting to be a competitive return. I'd probably raise a little cash here until the market settles down maybe at a little lower levels.